Here's what you need to understand. Yesterday was not just another volatile session in the precious metals market. What we witnessed was a systematic detonation designed to shake out every weak hand, every over-leveraged position, every recent convert who thought they understood silver, but didn't have the conviction to weather what the banking cartel just unleashed. And now, as the dust settles and traders assess the carnage, something remarkable is happening that the mainstream financial media is completely ignoring. Silver is finding support at $75. Let me say that again because the significance cannot be overstated. After one of the most vicious intraday sell-offs in recent memory, silver isn't collapsing back to 60. It's not even testing 70. The metal is consolidating in a tight range just above 75. And if you understand market structure, if you've studied how genuine bull markets behave versus manipulated corrections, you'll recognize exactly what this pattern represents. This is accumulation. This is institutional repositioning. This is the moment where smart money separates itself from the emotional retail crowd. Think about what actually happened yesterday. Silver spiked above $83 in early trading, triggering a cascade of profit-taking and stop-loss orders that the algorithms were specifically programmed to exploit. Within hours, the price had plummeted nearly $9, wiping out gains that took weeks to establish. Social media exploded with panic. Comment sections filled with declarations that the bull market was over, that we'd seen the top, that anyone still holding silver was about to experience financial devastation. Classic fear programming, textbook psychological manipulation. But here's what the panicked merchants don't want you examining too closely. In previous correction phases over the past 3 years, silver would routinely give back 15 to 20% of its gains before finding stable support. We've seen the metal drop $8, $10, $12 in a matter of days, grinding lower for weeks as sentiment turned toxic and capitulation became the dominant narrative. Those corrections felt different. They had weight. They had the structural characteristics of genuine bear moves within a broader consolidation pattern. Yesterday's action was nothing like that. The sell-off was violent, concentrated, and almost immediately absorbed by buyers who stepped in with conviction that tells you everything about current market dynamics. By the close, silver had recovered nearly half of its intraday losses. Overnight sessions saw continued bid support. And this morning, we're watching the metal stabilize in the mid to upper 70s, with volatility declining and order books showing substantial buy interest at current levels. This isn't how tops are formed. This is how consolidation platforms are built before the next leg higher. Now, let's connect the dots between what's happening in silver and the broader currency crisis that's accelerating faster than most analysts predicted. The dollar index just printed its lowest weekly close in over 3 years. That's not a typo. Despite all the rhetoric about American economic strength, despite the Federal Reserve's attempts to maintain credibility, despite endless mainstream media cheerleading about dollar dominance, the world's reserve currency is in structural decline that's becoming impossible to disguise. And the people who manage serious wealth understand exactly what that means. When a reserve currency enters terminal decline, capital doesn't simply disappear, it migrates. It searches for stores of value that can't be debased by central bank policy, that can't be diluted by political expediency, that maintain purchasing power across currency regimes and economic systems. Throughout history, this migration has consistently flowed into precious metals, and what we're witnessing right now is the early phase of that pattern playing out in real time. The key insight here is $75 isn't just technical support. It's a psychological and financial line in the sand that represents a fundamental repricing of silver relative to fiat currency risk. Let me explain what that actually means in practical terms. 3 months ago, silver at $75 would have been considered an absurd peak, a blow-off top that contrarians would short with confidence. The metal spent years trading in the 20s, occasionally spiking into the low 30s before getting smashed back down by coordinated paper selling in futures markets. Sustained price levels above $50 seemed like a distant fantasy reserved for hyperinflationary scenarios that serious analysts dismissed as doom-porn nonsense. Yet here we are. Silver is holding 75 after touching 83, and the market is treating this level as baseline support rather than extended valuation. That shift represents something profound. It means market participants have collectively adjusted their expectations about what silver is worth in a world where currency stability can no longer be assumed. It means the old trading ranges, the old resistance levels, the old mathematical relationships between silver and other assets have been permanently broken. It means we've entered a new regime where precious metals are being revalued not based on industrial demand or jewelry consumption or technical chart patterns, but on their fundamental role as monetary assets in a system where confidence in fiat currencies is evaporating. Here's why that matters. Once these psychological recalibrations occur at the institutional level, they're extraordinarily difficult to reverse. Think about what it takes for major funds, sovereign wealth managers, and high net worth family offices to completely restructure their understanding of asset valuation. These aren't retail traders chasing momentum or getting spooked by intraday volatility. These are sophisticated operators managing billions in capital who make allocation decisions based on multi-year outlooks and fundamental macro analysis. When they determine that silver belongs in a new trading range, when they establish positions based on that conviction, they don't panic sell on a single day's volatility. They use corrections to add to positions. They view weakness as opportunity. They understand that the transition from one regime to another is never clean or linear. And that's exactly the behavior we're seeing in current order flow data. Large block trades are coming in on dips. Physical demand remains robust, even as paper markets experience turbulence. Premium structures in retail and wholesale markets continue to signal tightness that doesn't match the price action in futures trading. The disconnect between physical and paper markets has never been more pronounced, and that divergence is telling us something critical about where actual supply and demand fundamentals stand. This is the moment where conventional market analysis breaks down completely because the assumptions underlying traditional models no longer reflect reality. Let's talk about what those traditional models are missing. Standard precious metals analysis typically focuses on industrial consumption data, mining supply projections, central bank buying patterns, and inflation expectations derived from government statistics. Analysts build elaborate spreadsheets, modeling supply-demand balances, calculating theoretical price targets based on cost curves and historical valuation ratios. It's all very scientific, very data-driven, very professional, and it's completely irrelevant to what's actually driving current price action. What's happening in silver right now has almost nothing to do with industrial demand trends or mining output forecasts. We're watching a fundamental repricing based on monetary crisis dynamics that haven't been seen in generations. The comparison is not to 2011 or even 1980. The proper historical analog is the currency collapses of the 1970s, the breakdown of Bretton Woods, the periods when the entire global financial architecture was being restructured under crisis conditions. Those weren't normal market environments. Traditional analysis didn't work. The experts were consistently wrong. The people who understood what was really happening, who positioned themselves accordingly, who ignored conventional wisdom and trusted their understanding of monetary fundamentals, those were the people who not only preserved wealth, but generated generational fortunes. Now here's where it gets even more interesting, and this is something I haven't seen discussed anywhere in mainstream financial coverage. Look at the correlation breakdown between silver and virtually every other asset class over the past 6 weeks. The metal is increasingly trading independently of stocks, bonds, crude oil, even gold to some extent. Those traditional correlations that algorithms rely on, that risk models assume, that portfolio managers use to construct balanced allocations, they're disintegrating in real time. You know what that signals? It means silver is transitioning from a commodity to a pure monetary asset in the eyes of major market participants. Commodities trade based on industrial cycles, economic growth expectations, demand forecasts tied to manufacturing activity. They correlate with equity markets because they're driven by the same underlying economic dynamics. But monetary assets, true stores of value, they operate according to different rules. They respond to currency instability, sovereign debt concerns, central bank credibility crises, systemic financial risk that has nothing to do with GDP growth or corporate earnings. The fact that silver is decoupling from commodity behavior patterns and beginning to trade more like a crisis hedge tells you everything about what institutional money sees coming. This is where it all connects. The dollar's decline, silver's new support level, the changing correlation structures, the divergence between paper and physical markets. It's all part of the same underlying phenomenon. We are experiencing a loss of confidence in the current monetary system that's spreading from the periphery to the core. It started years ago in emerging markets, where currency collapses and inflation crises taught populations not to trust government promises. It accelerated during the pandemic, when central banks printed trillions while pretending there would be no consequences. It intensified as inflation proved persistent rather than transitory, as debt levels reached points that everyone knows are mathematically impossible to service without debasement. And now it's reaching the final stage where even developed market populations, even American investors who've spent their entire lives trusting dollar stability, are beginning to question assumptions that once seemed unshakable. That's a process that feeds on itself. As more capital migrates to hard assets, as more investors seek alternatives to currency-denominated wealth, as more institutions build precious metals positions, the remaining pool of confidence in fiat money shrinks proportionally. It becomes a reflexive dynamic, where the hedging behavior itself validates the concerns driving the hedging behavior. Yesterday's volatility was a stress test of that dynamic. The banking cartel, and make no mistake, coordinated paper selling on that scale doesn't happen organically. They wanted to see if they could still shake the tree hard enough to generate panic selling. They wanted to determine whether recent buyers had genuine conviction or were just momentum chasers who would fold under pressure. They needed to know if they could still control narrative through price manipulation the way they have done for decades. The answer they got should terrify them. Silver absorbed everything they threw at it and stabilized 75. The weak hands got shaken out, sure. Some overleveraged traders got liquidated. Retail panic merchants got their clicks and views. But the underlying bid, the institutional accumulation, the structural demand from serious money that understands monetary dynamics, that didn't waver. It stepped in. It bought the dip. It established the $75 floor through actual capital deployment rather than narrative management. That's a massive development that changes the entire game going forward. Here's what you need to understand about how this affects the next phase of price action. When manipulation attempts fail to achieve their objectives, when the cartel expends ammunition on a smash that gets immediately absorbed, it actually accelerates the transition to the next trading range. They've shown their hand. They've demonstrated that they can still generate short-term volatility but can't break the structural support. And sophisticated traders pay very close attention to those reveals. Think about the psychology from the institutional side. If you're managing a large fund and you watched yesterday's action, what's your takeaway? You saw a violent sell-off that should have triggered cascading liquidations and multi-day downtrends based on historical patterns. Instead, you saw aggressive buying at lower levels and rapid recovery that suggested powerful forces are supporting prices. You saw physical markets barely react while paper markets gyrated. You saw a demonstration of underlying strength masked as weakness. That's exactly the kind of market behavior that triggers FOMO at the institutional level. Because the managers who don't yet have positions realize they're running out of opportunities to establish them at anything resembling reasonable prices. Let me share something that most analysts won't tell you because it doesn't fit their comfortable narratives. The biggest risk in this market is on a crash back to 60 or 50 or wherever the bears are predicting. The biggest risk is a gap-up move that leaves cautious investors completely behind, forcing them to chase at significantly higher levels or miss the entire transition. Here's something I find fascinating about silver recovery begins. Why 75 is the new floor versus the dollar after yesterday. Yes, Bloodbath. That's how major secular shifts actually play out. There's a period of volatility and uncertainty where most people are too scared to commit. Then there's a relatively brief window where accumulation happens and smart money builds positions. Then there's a phase transition where price discovery moves to a completely different range, and the opportunity to get in at earlier levels simply evaporates. We're right at the boundary between the second and third phases right now. The $75 support level represents the last opportunity to acquire silver before the market's center of gravity shifts permanently higher. I'm not making predictions about specific price targets or timeframes, but I'm telling you that market structure strongly suggests we're near the end of the accumulation window. The next major move will likely be a breakout that takes silver through the previous high and establishes a trading range centered around $90 to $100 as the new normal. Now, let's connect the dots on something else that's receiving almost no mainstream attention. Look at the silver to gold ratio over the past month. We've seen compression from 90 to 1 down to current levels around 75 to 1. That's a massive shift that indicates silver is outperforming gold on a relative basis, which historically only happens during specific phases of precious metals bull markets. Specifically, it happens when monetary crisis dynamics shift from concern to panic. Gold typically leads during the initial phases when sophisticated money recognizes problems on the horizon. Silver catches up and eventually outperforms when those concerns become mainstream, when retail participation increases, when industrial users begin securing supply out of availability concerns rather than just-in-time inventory management. We're watching that transition happen in real time. And here's the critical factor that most analysis is missing. Silver's dual nature as both a monetary asset and an industrial commodity means that supply-demand dynamics can become extremely unstable very quickly. Industrial users can't simply decide to stop buying silver if prices rise. They need the metal for manufacturing processes that have no viable substitutes. When those industrial buyers start competing with investment demand in a market that's already physically tight, you get price discovery mechanisms that move much faster and more dramatically than gold. This is why silver bull markets historically see moves that make gold's gains look tame by comparison. Now I want to address something directly because I know the skeptics are already formulating their counter-arguments. This is just another bubble. Silver always crashes. Everyone who bought at the top last time got destroyed. You're just pumping your position. Let me be very clear about something. I don't need you to buy silver. I don't benefit from your decisions. What I benefit from is understanding market dynamics better than people who are still relying on outdated frameworks and conventional wisdom that stopped working years ago. And what I am telling you is that the environment we're in right now is fundamentally different from 2011. from 1980, from any previous precious metals rally you might want to compare it to. This isn't a bubble driven by speculation and momentum. This is a structural repricing driven by currency crisis dynamics that are still in early stages. The difference matters enormously. Bubbles pop when sentiment shifts, when the marginal buyer disappears, when leverage unwinds and momentum reverses. Structural repricings persist until the underlying fundamentals change. And the underlying fundamentals driving this move, the loss of confidence in fiat currencies, the unsustainable debt levels, the central bank credibility crisis, those aren't resolving. They're accelerating. You want to know how I know we're still early in this process? Look at retail investor positioning. Despite silver trading at multi-decade highs, despite months of strong performance, retail ownership of precious metals as a percentage of total investment portfolios remains near historical lows. The average investor still has the vast majority of their wealth in traditional stocks and bonds, still believes in the conventional 60-40 portfolio allocation, still trusts that the financial system will continue functioning basically as it has for the past 40 years. That's a position that will prove catastrophically wrong, but the key point is that we haven't yet seen the panic rush into hard assets that characterizes late-stage precious metals bubbles. When that happens, when your neighbors are asking how to buy silver, when financial advisors are recommending precious metals allocations, when mainstream media coverage shifts from skepticism to enthusiasm, that's when you start thinking about exits. We're nowhere near that phase. We're still in the phase where most people think you're crazy for buying metals, where conventional analysts confidently predict imminent crashes, where the narrative remains that this is all just temporary volatility that will resolve back to normal. Which brings me to the most important question. What is normal now? The key insight here is normal has changed. The trading ranges from 2015 to 2020 aren't coming back. Silver in the 20s is as obsolete as gold at $300. The entire framework has shifted, and the sooner investors recognize that reality, the better positioned they'll be for what's coming. Here's what normal looks like going forward. Expect silver to establish a trading range between $75 and $95 over the next several weeks as the market digests recent volatility and builds energy for the next leg higher. Expect continued disconnects between paper and physical markets as futures trading becomes increasingly divorced from actual metal availability. Expect mainstream narratives to remain bearish even as prices trend structurally higher, because the financial media serves institutional interests that are net short precious metals and desperately need to prevent mass migration out of dollar-denominated assets. Expect volatility. Expect more manipulation attempts. Expect days that make yesterday look calm, but also expect the underlying bid to remain robust. Expect physical demand to stay strong. Expect the $75 support level to hold absent some massive unforeseen crisis that changes the entire global financial landscape. And even if we do see another spike down, expect it to be bought aggressively by interests who understand that silver at anything close to current levels represents extraordinary value relative to the currency crisis we're experiencing. This is the moment where you either understand what's happening and position accordingly, or you remain anchored to conventional frameworks and watch from the sidelines as the biggest wealth transfer in generations plays out. Let me give you a specific example of how this plays out in practical terms. Say you're an investor who's been watching silver rise with increasing interest, but couldn't quite pull the trigger on a position because it seemed too risky, too volatile, too far from established norms. Yesterday's action probably confirmed all your fears. You saw the crash and thought, see, I knew it. I knew this was a bubble. I'm glad I didn't buy. But that exact reaction is what separates investors who build lasting wealth from those who remain perpetually on the sidelines. The ability to see through short-term volatility and recognize underlying structural strength, that's not a common skill. It requires conviction based on fundamental understanding rather than emotional comfort. It requires willingness to act when price action seems to contradict your thesis, knowing that market structure tells a different story than headlines. The investors building serious positions right now aren't fazed by yesterday's volatility. They expected it. They understand that transitions from one regime to another are never smooth. They know that the banking cartel will fight every step of the way to maintain the illusion of control. They've studied enough market history to recognize that the path from 75 to 150, which is where this goes in any reasonable scenario, will be marked by volatility that shakes out everyone without genuine conviction. Now I want to address the dollar side of this equation more directly because silver's strength is ultimately inseparable from dollar weakness. What we're witnessing isn't just precious metals rallying. We're watching the slow motion collapse of confidence in the world's reserve currency, and that's a phenomenon with implications that extend far beyond commodity prices. The dollar's role as global reserve currency has allowed the United States to run enormous trade deficits, to maintain debt levels that would destroy any other nation's currency, to export inflation through monetary expansion while maintaining relative price stability at home. That exorbitant privilege, as it's been called, has enabled a standard of living disconnected from underlying productivity for decades. But privileges end when the underlying power structure supporting them erodes.